All right, Canadian Wealth Secret Seekers. This is an episode about risk and the mindset of risk. And it stems from a conversation we've had numerous times with our clients, with partners of ours. And it really comes down with this kind of mindset about this dichotomy between right and wrong. And the idea here is that people who are obsessed or striving for being right often take less risks than people who have a mindset that says, I may be wrong, and actually most likely I will be wrong, but I am okay with being wrong because I have a plan for what to do when I am wrong. And I think that is the breakdown of kind of where this rant, that I'm doing right now for you is to help you think about risk. This is coming off our meeting with, right away with our client. And the client was trying to think about some of the moves they were making. And they're like, I want to make and you hear this a lot, I want to make the right moves. I want to go down the right pathway. I want to make sure it's right. And I think the mindset of, again, being right and focusing on that is actually the wrong pathway, is that we don't want to say which one is right. We want to just say, what is our system? Like, how are our systems designed to support us when we are wrong? Because we actually are going to be wrong. We've got so many overconfident people. And I think here's where the crux comes from, or the actual underlying fear comes from. Obviously, we don't want to be wrong. There is loss aversion. Like, loss aversion basically says, like, we fear wrong more than the value of winning. So we actually avoid risk. It comes from a very famous study with coin flipping and betting on coin flips and knowing that if I got paid for $1 or I lost $1, that coin flip, we'd have to earn more than a good chunk of upside in order for just to offset the risk of losing the appropriate downside. We fear, and it hurts more when we lose things that we feel like we've lost versus gained. And that's called loss aversion. It's a bias that we all have. And I think that's where this kind of like this mindset of like, I want to make sure I'm right comes from, and just accepting the fact. And this is what my main message here is: accept the fact that you are going to be wrong more times than you're going to be right. And if you accept that, you actually will be better off. You will be the bigger winner down the road, because people who are focused on being right take less risks. This business owner didn't want to move forward with a particular deal because, the deal wasn't perfect. The deal wasn't going to be, well, here's the thing. You don't know if the deal is going to be a grand slam, but it hit some check boxes, and there were some check boxes that maybe didn't get checked off, but they didn't move forward. And the reason they didn't move forward was like, I don't want that to be a loser. I don't know what we're going to do here about if it's a loser. And that right there. So like that part about not knowing what to do, like, which means you didn't design the deal to account for a cushion of safety or the margin of safety. And when we don't have that, that will prevent us from knowing what to do when we're wrong, because like we are going to be wrong more than we are right. And markets, investments, ideas, they don't reward people who avoid being wrong. They avoid people who adapt, and they avoid people who adapt quickly. So the question here isn't, what do we like? I don't want to move forward because I may be wrong, or I'm not going to, and this might not be the right move. It's, what are the moves to make when we are wrong? And do I feel confident that I can make those moves in this type of margin of safety? Because we don't want to make that work. Another kind of bias that we all hold that I think holds us back from taking appropriate risks or making appropriate risks is the sunk cost fallacy, which is basically throwing bad money after bad money and not knowing when to get out. And that's the part about the system, right? So if I make a move in this way, so let's say I invest in this stock on the stock market or in this ETF on the stock market, and I'm going to go in, even if I do go in with the assumption that I'm going to be wrong on this move, then I have to know what is my moves to say deal with the wrongness that happens there. What is my stop loss? What is it going to look like when to get out? Because when things do go wrong, and this is, I think, why people who are focused on being right more than the system have an issue with this, is because when they have been wrong in the past, then they double down on the wrongness, right? Because it's like the sunk cost fallacy kicks in. I've already invested this much. I shouldn't take my losses and walk away. Or I've already kind of gone down this road and now we have to just live with it for the rest of the year or 2 years or 3 years or 5 years. This property I've just got, it's going to like work out. Like that mindset is, I think, tied to the people who are focused on making the right choices versus appropriate risk calculated choices, or just know that they're going to be wrong. The sunk cost fallacy holds us back there. The other kind of fallacy here in bias, which is overconfidence bias, which is, investors, business owners alike overestimate their own intuition and underweight data, underweight conditions, underweight information that makes them change their mindset or their mind immediately. And that comes down to it's very much paired with the sunk cost fallacy, because we've got a saying here, which is basically you can have strong beliefs or strong convictions, but just loosely hold them. And when we make that choice, I'm going to go in with this deal right now. So I'm knowing that I'm going to be wrong. I'm going to make this deal. I have my backup plan. I have my system designed to support me when I go down this path, which is linked, your vision for Matt, your financial plans come true, which is our stage 1 of our financial planning system. The overconfidence here is that we're going to forward the overconfidence here is when the overconfidence comes because I've realized that the overconfidence is here because I've got new information. I got new data that's telling me that my old belief or my old conviction isn't true anymore. And am I willing to pivot? Am I willing to make the choice? Like all of these ideas are really tied to risk and really tied to how we handle being wrong. And I flipped the mic on here to talk to you today about this because we see this so often with our clients. We see this often with the people that we talk to regularly. I'm sure you see this often with folks that you're interacting with, your spouses, your loved ones, your family members, your children. Taking risks isn't about say, oh, I just don't want to what happens if this doesn't go the way it is? Just assume it's not. And then plan for the worst case scenario. That whole saying, it comes down to this very common saying that we all say. It's hope for the best, plan for the worst. It is a true statement, but a lot of times in finance, we don't do this. In business, we may not be doing this. One of the really important philosophies that I follow is also another common phrase around the same idea. It's not maybe say directly related to risk in the way that most people use this, but I see it this way, which is plans are useless, but planning is invaluable. And I think that the act of thinking about your vision for where you're trying to go, your act of stage 2, which is, looking at your wealth reservoir, making sure that you have access to liquidity, which is very much tied to how risky you can be. Stage 3 is optimizing your structures, your different accounts or tax situations or different ways to position yourself to take advantage of different, say, pieces that allow you to pay less tax maybe, or earn more income. The stage 3 is an essential component of a healthy wealth planning system. And then your estate planning and your legacy planning is stage 4. But, the planning work across the 4 stages is essential. And if you can do the planning, the more planning time, why it's so invaluable is if you can map it out, if you can look at this case and you look at this case, oftentimes we don't budget time in our day or in our planning work for this, whether we're a business owner or whether we're an investor or an entrepreneur. Planning time is so valuable, but we often think that I didn't do any actions today, or I didn't get this done today, so then it feels like you wasted your time. But the planning is the invaluable part, because without the planning, without that stage 1 visionary work, then it really makes it hard to take action. It really makes it hard to get out of that mindset of being right. Just know that you're going to be wrong. It's about being adaptable. And the people who succeed long-term are those who build systems that can survive being wrong and move forward. And if you're only betting on when you're sure, you're not betting enough, because when you make those bets and you make enough of them, the winners outweigh the losers. And that's why people who are holding back and only going in on when they know they're right, they actually invest less. They make less sound financial decisions, whether in business, whether in life. They're too concerned about being right. So instead of asking, is this the right pathway or the right move or the right investment? Instead, ask, what will I do when it's wrong? And does that still make it a good deal? What does it look like? What does my system look like to handle that scenario? And that's the thinking that we do. And right now, this is the thinking that we're trying to help our clients with when designing their financial systems and guide them along their pathway, guide them along the business deals they're making, guide them along the investments they're making, guide them along the structures they're putting in place to optimize their goals. It's not about being right. It's just about what to do when you're wrong. If you want to know more about the 4 stages that I outlined here in a healthy financial system, head on over to CanadianWealthSecrets.com/pathways. In there is a quick assessment. After you complete your assessment, we will email you a customized report that gives you an assessment of those 4 stages for you, and also some next steps on what you can do to maximize your impact, maximize your outcomes.